Okay, folks, so we need to talk about 3 different things to finish off this week. Number 1, I want to give an update on squeeze plays. For example, SPRT had its anticipated sell the news sell-off. It got its merger, and then it sold off, and guess what happened? Well, short sellers got even more greedy, increasing short interest yet again, 3%, nearing close to 90% short. This is quite frankly just beautiful and insane at the same time. Number 2, I want to give a quick update on Ooga Booga AMC. It did break into the 50s today. And then lastly, I want to talk about something that's increasingly alarming and something that you need to be aware of. And the only thing that I ask in return for all of this is that you hit that ravishing like button, and also don't forget to subscribe either. Okay, SPRT. So voters approved the merger, and we got our anticipated selling of the news. Most of the pre-anticipatory running happened throughout the week. Fairly disappointing overall. I think it went from Tuesday's low at 774 to 2766, which was okay, but I was hoping for at least another break or a stronger attempt into the 30s. Though on the bright side, it did manage to hold our $20 level, which is something. But anyways, again, what's so intriguing about the sell-off is that short sellers got even more greedy into it. Short interest now up to 89%, according to Ortex estimates. If this was officially exchange-reported public short interest, this would be the most shorted stock in the market right now. And at the end of yesterday's video, I said, let the short sellers sleep well into the weekend. Let them feel like they were right. Let them rest their little heads on their little Egyptian cotton sheets. Because I strongly believe that there are a lot of retail traders on the sidelines and probably warring hedge fund buyers that are ready to pop in post-merger and take advantage of this new Greenidge deal. So you get a little bit of buying inflow on a heavily shorted stock like this, and it doesn't take too long for this to get real nasty. Remember, short sellers right now are very, very confident that there's going to be absolutely no buying pressure anywhere. Problem is, if there's any buying pressure at all, even on a short-term basis, they could be wrong very, very quickly. And if not, hey, don't play it again. We had a very fun run from $8 to $59, and the benefit of being a trader is that you can be stoic about whether you get more opportunities or not. But all I'm saying is, hey, I would continue to watch this one because when it wakes up, well, I would not be surprised at another hurrah. Okay, the CEI play, which we anticipated inflows and a continuation of pattern earlier this week on Tuesday, has continued to take off, capping off another 18% run at highs into 166. You also saw shorts backtrack a bit today. Maybe they didn't like me making fun of them in yesterday's video for increasing their short positions 40%. That being said, the elephant in the room when it comes to predictions on short squeeze stocks is that we don't really know exactly when buying pressure is going to come in, or even if enough buying pressure is going to come in to put shorts into a riskier and riskier headlock. So what we're really doing is just analyzing trends and trying to be prepared for when they do run. Speaking of which, BBIG has held pretty well the last couple of days. Little of a sell-off towards close, but overall this has held so strong, it's been so stubborn that I'm impressed. If history repeats itself, it should take another breath towards our red directional SMA line and then attempt another reversal next week. There's always that risk that if it takes too long to breathe, perhaps it has to restart from a much, much lower price and rebuild that momentum, which can take some time. But remember, we do have concrete catalyst dates with this thanks to the whole Cryptide dividend spinoff situation, which we discussed 2 videos ago, and you can check that out for the full breakdown. But when you get into October, I wouldn't want to be a short seller holding through the dividend spinoff. Let's just say that. That's going to be a nasty situation. After it continued its own stair-step pattern, holding its overall upward direction, I was expecting at least some breath, but this just hasn't wanted to breathe at all. It's a fish with gills. Quite frankly, there's a lot of angry sentiment under the surface with this play. There's a lot of people who bought this earlier in the year that are frustrated with how much short sellers accelerated the downtrend and how much money they made off them. Short sellers that I know, shockingly, have gotten way too greedy and way over their heads again. Short interest was always high on this play, but when it really exploded was after Atter's price had already been cut in half. And this follows the pattern that we've seen pretty much everywhere. Short sellers try to accelerate a race to the bottom. And even when something like this goes from $48.99 to as low as $3.04 a share, what do they say? They say that's not enough. $3? LOL, I want this at 3 cents. Even more, I'm not gonna leave even a penny of valuation in the stock for the damn retail traders who hold this. How do we know this? Well, if you look at the short interest, despite Atter being at literally record lows at this price, short interest had only gone to record highs from that point. You have record low prices, record high short interest. This is the equivalent of being at war with a huge enemy. fighting them tooth and nail for months and months in a very dirty battle. And then when you finally have them on their last leg and they're super weak and can barely defend themselves, then you decide to go and nuke them. It's like, why didn't you just use the nukes in the beginning? Why'd you save the nukes for when you didn't even need them? In the stock market, you don't care about casualties, so that couldn't have been it. Don't pull that card. If they had such high conviction that Apter was worth so little, why didn't they start doing this at much higher prices so they could have realized much more downside? Why pile on all the shorts when the stock has already gone down like 85%? Unless maybe you're trying to rub it in people's faces and you want that extra $3 per share. Okay, AMC Ooga Booga. So in a huge blow to short sellers today, AMC finally broke out past that $50 resistance level that it's been trying to for weeks. Very excited to see that. If this can keep making headway into next week, we could be seeing a higher channel, maybe 50 to 60 even. Better yet, you could start seeing some more stair steps in the right direction. But if you look at the overall context, this solidifies more than a month of continued momentum since basically August 4th. This is now officially a momentum stock. You also saw GME do its traditional sell-off upon earnings this week, and you compare the chart of GME and AMC on the same time frame, and it's like, geez, there's a lot more enthusiasm for AMC. Whereas GME basically looks like bingo night at an old folks home. Somebody yells, "I got bingo," and then somebody else is like, "My hip hurts, shut up." 15 other people yell, "What? I thought we were playing Scrabble." If AMC really is a distraction from GME, boy, do I prefer being distracted. Okay, don't ruffle up your feathers. I'm just teasing our GME folks. Quite frankly, I support any stock that stands against unfair practices and manipulation in the stock market that have been punching us as retail traders in the face forever. Okay, lastly, so you're starting to hear more and more of the dreaded S word. Stagflation. Most recently this morning, CNBC ran a piece covering how a prominent B of A analyst sees that we are in the first phase of stagflation. Now, what is stagflation? Well, it's a period where you get inflation at the same time where you're getting lower and lower economic growth as a society. It's really the worst of both worlds because usually during inflationary periods, you're also getting very strong economic data and people are going out and spending like crazy. So money's circulating very fast and that bids up prices very quickly in a growing economy. People are making more money, but money's circulating a lot faster. And oftentimes the US has been able to avoid massive consequences for printing oodles and oodles of money during recessions, specifically because people hoard their cash during recessions and it doesn't circulate around very quickly. And then when it does and they're more confident, the economy is already back in recovery and heating up very rapidly. So you're getting inflationary pressures, but you're also getting an economy that's very strong and can handle it. The idea is that inflationary pressures start showing when the economy can take it. At least that's the goal. Print tons of money during a recession that's deflationary. Then when the economy starts getting back on its legs, well, inflation starts showing up in the data, and then if you need to curtail that, rein it in, you can raise interest rates or taper. But in a long and drawn out crisis with many ups and downs, it gets a little bit more complicated. For example, in a pandemic with rolling economic slowdowns caused by beautiful variants. And when you get one that's compromised by a lot of supply shortages in both materials and labor, well, you get massively increasing pressure during periods of time where the economy could start slowing down. What does that mean? Rising prices, slowing economy equals stagflation. And the article goes in to dive into how the most famous example is in the 1970s with the oil crisis. Oil prices rose dramatically. The economy slowed down dramatically. Average Americans were earning less at a time where goods and services started costing more and more. And the article's insinuating that we're in for a long run of this happening once again. And this particular piece makes the argument that in order to protect yourself against stagflation, you should focus on owning real assets like stocks, real estate, and commodities. It goes on to be specific in terms of stocks too, warning that tech stocks did badly during the 1970s and insinuates that you need to be avoiding those like the plague. My thoughts? Well, this isn't the 1970s. The tech sector is completely different than it was in the 1970s. Most of the tech sector is based around software. The manufacturing, labor, and material heavy tech sector, tech industry of the 1970s is completely different than the 2020 tech sector. And in terms of risks, I mean, really recommending you buy real estate at market highs after interest rates are at record lows and are only going to go up from here. Most of the population, even with low interest rates, can't even afford a starter house. And you're forecasting that even if they make a lot less money during an economic crash, all of a sudden they're going to have all this money to pour into real estate. And don't get me started on the mainstream stock market. It never ceases to amaze me the sheer amount of mainstream stock analysts that just want you to pour all your money into boring Dow plays. You really think that recovery plays at all-time highs that have factored in no manufacturing or labor shortages and have basically factored in the end of the pandemic being this year are the ones to buy? No, they've been doing terribly. If you're going to make an argument for anything that's powerful right now, it's the mainstream big tech stocks. You look at some of the big dogs like Apple, they're less exposed ever to material shortages. Revenue in a lot of these tech companies is coming more and more from software-oriented streams which continue to have exponential growth rates. Then you argue, oh, the money's in these Dow companies that have already factored in huge growth, and it's making some sloppy argument that prices are going to go up, labor's going to go up, so these companies are going to be worth more, which would be a fine and dandy argument if at the same time you weren't insinuating that the economy was going to slow down to a point that no one could even afford this stuff. This article continues the trend of overvaluing economic events in history that have literally nothing to do with today's economic events. That being said, the S-word, stagflation, is definitely appearing in some areas of the economy right now. And until we can move past a lot of these labor shortages and material shortages, until we can bring up consumer confidence back from pandemic lows, you're just simply not going to see the economic data that we want to see. But I'm also not so pessimistic like most in the media that this is the start of 5 years of stagflation and then a 50-year great reset that sees stock prices go down 99%. The economy is fighting for a comeback. Quarter by quarter, it's fighting the pandemic. It's fighting a lot of international supply chain issues. And it's having its ebbs and flows. This is an ebb. We need to have a flow. I think that a lot of these threats aren't long-term like you're seeing in the media. And the reason that they're telling you they're long-term is because they know you'll click it and you'll think, oh no, stocks are going to go down. Short to medium-term problem doesn't sound as dramatic and doesn't get as many clicks, right? But long-winded, huge reset sounds real good, and you're going to click that in a second. So something to think about. Those are my 2 cents. Anyways, folks, that caps off the video. If you have any questions, feel free to reach out to us below or join us on ZipTrader Circle. If you'd like to learn how to trade with our step-by-step lessons, our private chat, and of course our daily morning briefings, where we brief on what's happening in the market each morning and all of our favorite catalysts, well, I'll go ahead and put a link to that below. FUDSTOPPER50 coupon code will get you $50 off before checkout. And lastly, if you're wondering what broker to trade these stocks on, well, if you're a buy and hold trader, multiple days to multiple months or years, well, I recommend public.com/ZipTrader. Sign up with our link below and you will get a free stock. If you are a day trader or swing trader, I also recommend Webull. And with Webull, you will get 2 free stocks if you sign up and deposit just $5 or more using our link below. Anyways, folks, that caps off the video and I'll see you in the next one.